Hello guys, I hope everybody is able to see me, hear me and see the screen properly. सबको मेरी आवाज clearly सुनाई दे रही है? Can I get a quick confirmation on chat? I hope everybody is able to see me, hear me and see the screen properly. सबको मेरी आवाज clearly सुनाई दे रही है? Can I get a quick confirmation on chat? Okay, thank you very much guys for joining in. We're going to be doing a quick Maha revision. Okay, the purpose of this Maha revision is to basically walk you through the book, and I'll not be doing a full-fledged crash course. The intention is to basically walk you through few important topics and highlight that this is important and what exactly they are actually trying to tell you in those topics and how they can test you. Okay, so let us go to the first book, which is the Foundation of Risk Management, and I'm only focusing right now on the building blocks of risk management section. Now, the first part is foremost very simple and basic, so generally not tested heavily in the exam. Okay, I'm directly moving you towards the risk management process. Okay, now over here they can ask you something related to these last 2-3 points or something related to the first point. Okay, for example, how do you identify the risk? So one of the approaches is doing brainstorming, okay, talking to your subordinate, doing survey. Okay, this is the most difficult part. So they might give you some scenario, okay, and they might ask you what should be the step, okay, as a risk manager or as a risk management professional, when you're looking at the framework, what is the major step that I ideally need to take. Okay, over here the decision making is also very important. For example, this one, known unknown and unknown unknown. Okay, these two topics, I'm marking it as star. Basically, you should clearly identify the concept. And I look at the first part, which is known unknown. So basically, you have identified the risk. Okay, that is the reason. The first word is known. That means you have identified the risk. You know something like this can happen to you. Okay, but the impact. Okay, but the impact is unknown. Impact is unknown. That is how you should remember. Okay, the concept or the risk is known. Okay, that something like this can happen, but if this happened, what is going to be the impact? We have no clarity. For example, the best example of this would be cyber attack. If tomorrow there is a cyber attack on you or in your company, okay, you know this can happen. Okay, this has been happening around, but you don't know what is going to be the overall impact. So this can get tested. Okay, so remember this part. The next is your unknown unknown. Unknown unknown. Now this section, both the things are unknown. Okay, whether you will be able to identify the risk, that is also not clear, and the impact, okay, is also not clear. Both of them are not clear. Okay, so which kind of case would be this? COVID like situation. Okay, nobody anticipated because that was a very huge tail event or tail risk event. Okay, so these two concepts you should be remembering for the exam. Also know what is this, what does broadly tail risk event means. Okay, so whenever we talk about tail risk events, so you have to always remember this diagram. Okay, so this is suppose your average, this is suppose your average behavior. And when we talk about tail risk, we are talking about something which is far away from the average, a huge deviation. Okay, and that deviation gives you the tail risk event. Okay, which simply means that the chances, okay, the frequency of those events is very low. Okay, but when you look at the severity, okay, the severity is going to be very high. So remember that. Okay, the frequency and severity. Okay, if you have any query in between, you can post it on the chat section. I will try to address it. Okay, I'll try to address it. Okay, let us move. So this is the tail risk is what something you should remember from the exam perspective. They can ask you in theoretical question. Okay, they will give you short scenario. Okay, and they will ask you whether a tail risk means this or that, like that. They can also give you two statements and ask you to verify it. Okay, moving forward, this diagram is the same connected part. Now a lot of people have confusion that what is actually happening with unexpected loss. How is it connected to your known unknown risk? How is it connected? See, when we talk about expected loss, okay, expected loss is something which you have more certainty in your business. That means you know with more clarity that this is something which is going to happen. Like for example, bad debts. Okay, you know bad debts are going to happen 3 to 4, 5%. Unexpected losses, same thing, but it is increasing in the volume. Say for example, you have a bad debt, which is going up to say 35%. Okay, same thing. You know that this event can happen, and you are able to calculate also to a certain level. Okay, certain level where the impact could be. Okay, so you can think of unexpected losses known. You know the impact and you have good amount of certainty to identify the risk. Okay, this paragraph is very, very important. Okay, like from the exam perspective, they can ask you a decision making like situation. So they will give you 4 scenarios or 2 scenarios, and they will ask you to think which scenario will you pick up, and they will give you background, a small background about it. Okay, so 4 decision making that ideally you can take: avoid, retain, mitigate, and transfer. Now when we talk about avoid, so you have to think it this way. If suppose I am Adani Group and I want to enter into say power plant, and I want to start out the power plant in Kenya. If suppose I feel that the political situation is not good enough, I do not want to take the risk which is very high, my risk greater than the risk appetite also, then I can avoid that project. I will never enter into that project. Okay, so avoid is very, very simple. Don't go into that way. Okay, retain is basically you know that you cannot do anything about that risk. Okay, so generally companies, what they do is they try to first mitigate the risk. Okay, if they cannot mitigate the risk, which is this one, mitigate means they are taking steps. So easy example of this would be if I want protection, okay, in my office, so I will hire a security company. Okay, so I have taken steps on my own. Okay, and I have hired people as a security people who are going to take care of the risk, or they will mitigate the risk. Okay, a lot of times it is not possible for you to mitigate, or it is not possible for you to hire people. Okay, then what you can do is you can transfer the risk. So you can take some insurance, or you can hire some third party security company and you have an agreement with them, right? And then you basically try to transfer the overall risk to them and you have a contract with them. Okay, so generally companies try to analyze whether I can mitigate. If I cannot mitigate, can I transfer? Okay, the important part is how do I know whether I should retain? Okay, so you will do the cost benefit analysis. If suppose the overall cost is way higher than the benefit I'm going to get from reduction of the risk, okay, then it doesn't make sense to take that step towards that. So you basically try to retain that risk. Okay, you understand that, okay, this is a part of my business, I cannot do anything. Okay, so these are the concepts which can get tested in your exam. Okay, even though it might seem simple. Okay, the first 3 chapters of your book 1 might seem very simple, but the question that they're going to test you is more understanding based. Okay, more or less the next part does not seem much tough, so I'm not covering over here. The zero sum game is also not very heavily tested. VAR, again, the major focus of this chapter is not to make you comfortable with VAR, okay, or not to make you an expert in VAR calculation, because that is going to come in your book 4. So this section is also not generally tested. Economic capital is something what you should know. Okay, now generally to understand economic capital, you need to understand this. Okay, that you have an average. Okay, this is the negative side. You have the expected loss. Okay, suppose my expected loss is $100. You will calculate unexpected loss, which is nothing but you will try to calculate the VAR amount. Okay, and that suppose that VAR amount is around $1,000. Okay, the company generally they try to cover this expected loss by charging some fees, okay, or by charging some commission from the company or from the customer, or charges basically. So they are not worried about the initial $100, they are more worried about the $900. Okay, that $900 is something which is going to be the economic capital, something which is going to buffer. you against any loss. Now, in a lot of companies, they might not charge this $100. So this $100 itself will also be part of the economic capital. So in that case, $1,000 becomes your economic capital. So when you read this also, this section, they are saying, okay, if you calculated VAR of $2 million, that means if you keep $2 million, $2.5 million, you have a sufficient amount of buffer against that situation, against worst case situation. That is what the economic capital. So from the exam perspective, you should know what does economic capital means, how it is also different from regulatory capital. That is going to get covered in the later chapters also. Scenario analysis is more or less okay. Stress testing is okay. You can focus this section. Okay, when we talk about scenario analysis and stress testing, the basic differentiation between scenario and the stress testing should be clear to you. So generally in stress testing, we pick up a one parameter and we try to give a stress to that parameter. Okay, like for example, we say that interest rate, if it goes up by 300 basis point, what is going to be the impact to the bank? That is stress testing. But when I do scenario analysis, okay, I am looking at a situation in which 2-3 impacts or 2-3 factors can impact. Okay, 2-3 parameters can change. For example, there is a war between China and Taiwan. Okay, so your interest rate can also go up, so your stock market will go down, your GDP of India can also get impacted. So many factors can get impacted. Okay, so you have to be very clear what is the broader difference between scenario and stress testing. Okay, now in this paragraph, they have highlighted that you can either take historical sourced scenarios or you can have estimated variable, which is nothing but either you can create your scenario or stress testing based on what has happened in the history or something which you are taking a hypothetical situation. Like for example, you are thinking like China Taiwan war, not has happened in the past. So these are hypothetical scenario, but India-Pakistan war was history. So you basically try to understand what if the same situation happens right now, what is going to be the impact. Okay, so these things you should broadly know. They might test you in the theoretical concepts and they might ask you some cultural related part, some risk analysis related part, and they will test you the concept. Okay, answering to your query, Paras, so we are asking VAR gives us the probability, not the actual amount. Yes, that's correct. It does not tell you the magnitude, it only tells you the chances. Enterprise risk management, not very important. This first section is not very important over here till now. Expected loss, okay, what the formula of expected loss, very important. Okay, so probability of default, loss given default, okay, exposure of default, like that. Okay, now suppose if I want to add a twist over here, okay, what they can do is I'll give you a very simple example which has been tested in one of the past exam, okay, which is not directly given in the book. So suppose I have given a loan, suppose line of credit to Mr. A. Okay, there is Mr. A. I've given a line of credit to Mr. A, and that line of credit is say around $100. Okay, that means he can come and withdraw $100 at any given point in time. Right now, he has already withdrawn $60. Already he has done the withdrawal. Okay, the next one, okay, the remaining 40 is still not withdrawn. So ideally, okay, the question can come in like this. There is $60 which is already withdrawn, $40, there is around a 30% chance that he will come and withdraw. 30% chance. Okay, and then they will give you, okay, what is my PD? My PD is around 7%. Okay, my loss given default is 70%. And they are asking you to calculate the overall expected loss. Now, when you are calculating expected loss, see, PD is very clear, LGD is very clear to you, but how do you calculate exposure? So you'll have to take the entire $60 plus, okay, the 30% of $40, because that $40 which is still with the bank, okay, there is 30% chance that he can withdraw. So you have to take that, and this entire thing will become your exposure. This entire thing will become your exposure at default. Now, this is not directly given in the exam, but you might be tested like this. Okay, slight variation you should be able to pick up on the day of the exam. Okay, so I've just highlighted that section also. Next part in this entire section, the important concept or the way they can test you is this correlation risk. Okay, that means you have to understand the core values, that when I talk about unexpected loss, okay, this is my expected loss, I hope everybody is able to see me. Okay, and the unexpected loss. So if I'm saying on an average 3% of my customers default, when will this number go down to 35%? Okay, when my overall portfolio, in the overall portfolio, the correlation moves towards 1, goes closer to 1, then there is a very high good chance that entire portfolio is going to behave. Now this is very common, simple, but what happens is that in the exam, okay, they will not give you straightforward information. They will not give you straightforward information. Okay, but the core thing that they are going to test you is the correlation. Core thing that they are going to test you is the correlation. Okay. Also, one point which they have highlighted over here is that during economic expansion, that means when things are going good, nobody is worried about correlation. That is because even if 1 or 2 people die, there's no problem. But when the things are bad, the correlation becomes very important, because 1% default is going to have an impact on the other people also. So that is why over here also they're talking about correlation. So broadly, you should remember the correlation risk. The next section, okay, the risk relationship between risk and reward. Over here, they are basically trying to highlight that when you look at the credit spread, okay, what is the credit spread? So you have a corporate bond, okay, 10-year corporate bond, and a government bond, which is also for 10 years. And the government bond has a yield of 7, and the corporate bond has a yield of 10. Okay, that spread of 3% that you see, generally we call it as credit spread. Okay, now this credit spread, okay, is not only coming from credit risk, not only coming because this corporate bond is risky, credit risky. Okay, this is obviously one factor, but it's not the only factor. There can be liquidity related risk also. That means if the corporate bond cannot be sold easily, then you will expect a high yield from that bond. Similarly, there can be taxation related impact. If suppose the government bond is tax free and corporate bond is taxed, so obviously you will ask for a higher yield, and that higher yield represents your higher spread. So basically these 3 things is what they can test you in theory. Okay, these 3 things, and that is basically covered over here broadly. So I've just focused on that important part. Tolerance level also. So when we talk about tolerance level, you have to think it this way, that when the tolerance level is high, what does that mean? People are willing to take risk. They are not afraid of risk. Okay, so when they're not afraid of risk, more people will go and buy the corporate bond. When they start buying corporate bond, okay, then ideally your value, okay, the spread will come down. Okay, your spread will come down. Okay, so whenever the tolerance level is very high, people want to take risk, they are not worried about it. So your spread will ideally get narrow. Your spread will get narrow. Similarly, when we say that the tolerance level has gone down, okay, then what will happen? People are afraid. So spread will increase, or spread will become wider. Okay, so if I would have been in Garth's place, I would have tested you on this concept, okay, in the exam. Okay, so broadly, this is what I feel till now the important sections are. Basically, I'm trying to help you understand the concept. More or less, it's okay. This section, some of the drivers. So when we look at the probability of default, the PD, okay, so obviously the PD is driven by what is happening within the company. Okay, what is happening within the company. And the second one is that the PD also happens because of the external thing. Suppose everything is good in your company, but suppose the economic environment is not good. So because of which, what happens? Automatically the company start performing bad, and automatically the PD is increasing. Okay, so it's a combination of both internal and external factor. The next is more or less simple thing, conflict of interest. Okay, we will try to give the recording later, but I would expect that people join us for the live session. Okay. So conflict of interest. Now the conflict of interest can be tested in a very different ways in terms of risk management. Say for example, they might give you a scenario and say that, okay, you're managing front office, you're managing back office. What challenge you might face? So that is conflict of interest. So in scenarios or in questions also, the question will test you in such a way that either whether there is conflict of interest available or not, or they will test you in such a way that which of the factors can impact your conflict of interest or can increase your conflict of interest. That way they can test you. Okay. So over here they've just given you a brief. They have not gone into the detail. If you look at the exam, okay, they have not gone into the details of the section. Next part, this you can mark as star, which basically means that if you want to reduce conflict of interest, what you should do. Okay, conflict of interest could also arise. Suppose there is a manager in my business who is doing fraud. Okay, or basically his interest and my interest does not match. That's a conflict of interest. That is why he's doing fraud. So how do we mitigate that? We basically do a lot of training to the frontline managers or people who are interacting with the customer. Okay, there should be robust operational risk management processes in the business. Okay, periodic audits should happen. Audit means there is a separate team which is going to check. Okay. Answering to the query, why audit committee and senior management won't have conflict of interest? No, generally audit committee does have people from the senior management, but it also have people from board. So board people will also come and see what is happening in the audit committee to avoid conflict of interest, because he can ask question why certain things are not shown. Okay, I've tried to give you a brief. I hope till this point everybody's okay. Can I get a quick confirmation? The next section is market risk. Okay, now in the market risk, generally if they want to test you on basis risk, they will not test you from this chapter. They will test you from book 3. Okay, the concept of basis risk, whether the basis risk can strengthen or not. Okay, all of these things can get tested from that chapter perspective. Okay, over here they have talked about parallel shift yield curve, so don't worry about it much. Check it from the book 4 perspective. Okay, check it from the book 4 perspective. General market risk is more almost simple. Actually, they can ask you specific risk from they can mention it as idiosyncratic risk, which is nothing but something which is happening only within your company and can impact you. Okay, so over here, that specific risk or idiosyncratic risk is nothing but if suppose I am running an APT model, arbitrage pricing model. In arbitrage pricing model, I generally take macroeconomic factors. So what is that error in the arbitrage pricing model? That error is something which is happening specific to your company. That is nothing but your idiosyncratic risk. So they might connect this topic and the APT chapter and ask you that theory. Okay, so be clear on the concept. Also, you cannot diversify the market risk. Okay, but you can diversify the specific risk because you are holding more assets into your portfolio. Commodity risk is okay. Credit risk, yes. So over here, the settlement risk and the downgrade risk can get tested. Okay, now they might ask you, like there is a question also in your book asking you what all risks do you face? Is it downgrade, bankruptcy, likewise? So they have given you scenario. Similar questions can come in your exam. Now, what is downgrade? Your ratings go down. When the rating goes down because of the probability of default increasing. Okay, so that is nothing but your increase in risk. So company perceive this as an increase in risk. Now, if I am an investor, I would be compensated with higher rate of yield if there is higher chances of rating going down. Okay, for a creditor, the downgrade may eventually lead to a default. So this is an indication. Right now, the default might not have happened. The customer is still paying, but the downgrade is happening, which shows what is the future trajectory of whether we are moving towards default, whether we are moving towards bankruptcy or not. Settlement risk is very, very important. So you have paid something. Suppose on the final day of the contract, okay, there is Mr. A and there is Mr. B. Okay, and Mr. A has paid $100 million, and for B was supposed to pay, okay, 80 million euros, but that did not happen. A has already paid, but B has not paid. So on the final day, the settlement risk means you have done the part of your contract, okay, but the other party is not doing it. So there is a miss. That leads to your system settlement risk. Okay, they can ask you the settlement risk in detail. Okay, explicitly connected to Hertzstadt. What is Hertzstadt? Was a German bank which kind of faced this problem that they received something from the US counterpart, but they were not able to do the transfer because there was a moratorium from the government or from the central bank, and because of which the US counterparties, they faced lot of these settlement risk, and they can view a story around it, and they can ask you a question. Okay, so I'm marking settlement risk as star. So you should remember it broadly. More or less this is okay. From specific part, geography diversification, correlation between your risk factors. Yes, this can also get tested. So they might say that, okay, you are entering into a project, you see market risk, you see credit risk, they might give you some numbers. And even though by looking at the content, you might feel that this is very difficult. But in reality, okay, the content is basically trying to understand, they help you, they are trying to focus on whether there is any correlation between the factors or not. Okay, so the question can be varied on this concept, but the core thing is when you are doing any risk management aspect, okay, you also have to check whether the risk factors are connected or not, risk factor has correlation or not. Liquidity risk, both these things you should broadly remember. What is, so funding liquidity risk and market risk is also important from your level 2 perspective. Now, what is funding liquidity risk? Anybody from the audience, what is funding liquidity risk? Any idea? People can use chat GPT. So it is nothing but you do not have sufficient money to pay back. That is funding liquidity risk. Okay, you do not have sufficient money to pay back. Okay, so now how does it connect? How does it connect? Okay, so think about a situation. Think about a situation that suppose you have taken huge positions, okay, into futures contract, you have purchased, and you have used entire cash flow of yours into that. And what happens tomorrow? There is a margin call because there was a loss. Okay, you do not have money available, which is a funding liquidity risk, and because of which you take a decision to sell the asset. When you start selling the asset, what happens? The price of the asset will go down. Okay, the price of futures contract will go down. And when that happens, price of the future contract going down, what will happen? More losses you will have to book. Okay, so funding liquidity risk triggered more problems to you, more margin calls, and it can also lead to a market liquidity risk. So there is a connection. What is market liquidity risk? Temporarily you are not able to sell the asset because the market is not available. Okay, now how they can test you in the exam? Okay, the focus is ideally going to be over here, where they are explicitly highlighting that during 2007 and 8 crisis, also a lot of these banks, okay, they had created asset, they had created liability. So they created liability for a very short term. Okay, so they were using repo, okay, they were using what, commercial paper, and they created an asset which is generally for a long term, okay, generally for long term, which indirectly is nothing but say MBS, investing into MBS and all of that, right? So these were for 25 years. So automatically we realize there is an asset liability mismatch. So they can ask you a question on this. Okay, how does it impact your funding liquidity risk? Or they will give you a case, a small case with respect to 2007 and 8, what has happened, and the major thing that they want to test you is the asset liability mismatch. Okay, now over here, market liquidity risk. Okay, the transaction, see, the element of immediacy might need to be consummated with a significant discount. If I want to sell the asset immediately, because there is no liquidity available, if I want to sell the asset immediately, do basically have to sell it at a very low cost or the low price, which is nothing but you have to do a haircut. So you have to give significant discount to sell. So all of this can have a connection. So your funding liquidity risk and market liquidity risk can have a connection. Operational risk, generally they will not test you from this chapter. There is a specific chapter in book 4. From that they might ask you case studies. Okay, cyber related, there is one case study. Then rogue trader, there is a small case study. So they can test you over there. Legal and regulatory risk is okay. Business strategic risk is generally not tested. Reputation risk can be tested. Okay, so they can connect you with the case study, okay, of Volkswagen from your book 1, and that case study, okay, can be basically connected and highlighted that how does reputation risk has increased or what led to the reputation risk increase, like that. Broadly, you should know what is the reputation risk for a bank. This is the important part. For the bank, the perception that there is a challenge, or basically if the market's confidence goes away from your bank with respect to your reputation, that is a bigger problem. With respect to your ability to do transaction in the market, that is the reputation risk. So banks generally face this kind of risk, that nobody trusts them and nobody wants to give them the money, and every customer wants to take their money back. So it's a run on the bank. So they might connect the run on the bank with the reputation risk, and they might connect it to the case study. Okay. Perception of lack of fair dealing. This is a very common reputation. If I don't deal with you properly, I might go and talk bad about, you might go and talk bad about me. Okay, that's a reputation damage for me. That is very basic, simple. Okay. So they've talked about cyber attack also over here, which is generally the part of the cyber attack can also lead to reputation risk. Your customers are not able to do transaction, they are pissed off with your service, and that because of which the impact is high. So overall, this is okay. Risk factor integration, yes. So over here, the aggregation. So how do we aggregate? What is aggregation? Basically, say I have transaction happening. This is my firm. So I have A business, I have B business, I have C business. Now for each business, I'm going to calculate the risk. Okay, for each business. How do we aggregate? So how do we add all of them to calculate the risk at the firm level? Okay, now it might seem easy, but it is very complicated. Now in the exam, they might test you that what are the complications into the risk aggregation process. Okay, so what are the challenges? So first of all, each risk is very complicated. Certain risk you can quantify easily, because suppose market risk is more data driven, but when we go to reputation risk, when you go to strategic risk, it is not very quantitative, it is more subjective. So the complexity comes from it, because each risk is different. That can be one area. Okay, so that is one section. Next is if suppose you are using multiple derivatives into your portfolio, then it is becoming very difficult for you to calculate the risk and add, because there is swap also, there is options also, then there is FX also, FX product, FX forward. All of them can increase the risk in a different way. And if you're having options or delta gamma option Greek chapter, that can also increase the riskiness. So that is what they might test you. So if you read this paragraph, from the exam perspective, the concept should be what leads to the risk aggregation being more complicated. That can get tested. Okay, now over here, they've talked about the problems of VAR. Broadly, the problem is very simple. It is nothing but different methods of VAR being available, or data is not clearly available, or for example, VAR only talks about the percentage chances, that okay, this much percentage chance that you will have a loss like this, but it does not clearly highlight the magnitude. That is where you come to expected shortfall, right? In the exam, and this is there in your book forum, they might ask you a question like this. Suppose this is my tail. Okay, this is my tail and this is my VAR. If the VAR number is negative 10%, okay, and there are like 4 more data points above that. Suppose this is negative 40%, negative 30%, negative 25%, negative 17%. If somebody asks me, okay, my VAR is at 10%, what is going to be the expected shortfall? So you'll have to take all of this. You don't have to include VAR. You just take all the other things apart from the VAR, okay, in the tail side, and you just do the average, and then you will get the answer. Just do the average. Okay, so that is the expected shortfall calculation. So from the exam perspective, the expected shortfall ideally tells you about the magnitude of the losses. So this is something which you should remember. Okay, or they might ask you in theoretical part again, what is the connection between the magnitude and expected shortfall, like that. Risk adjusted return, mark this formula star. Now historically they have not tested this, but I feel that they can ask you, they can give you the concept of RAROC, where the denominator is economic capital. So they are asking for 1 unit of economic capital, what is the return that I am generating? Okay, that concept should be clear in your mind. Okay, and if I'm not wrong, they have also highlighted that the reward to risk measure. Okay, that means for per unit of risk, what is the overall return I'm generating? This also you can remember how do RAROC is actually used. So it is connected to your business comparison, which business is generating what kind of RAROC, or what is the return that they are generating. Investment analysis also, which nothing but tell you that if I'm planning to invest into different assets, whether the return that I'm expecting from that asset, is it actually going to match the requirement level or not. Pricing is nothing but you try to analyze. See, a lot of companies, what they do is, they, before they decide the price, they basically take the cost and all, and they see that okay, how much profit, how much RAROC I want from this project. Okay, 10%. So they will take the base price and they will include that 10% to match the profit margin, and then they decide the pricing strategy or the price basically. Broadly, risk management, which is nothing but if the company is well settled, then ideally they should have a structured risk management approach towards the risks that the organization is facing. So broadly, we have completed the first chapter. I'm trying to give you the important concepts itself. I'm not doing the entire crash course. Okay. Let us go to the second chapter. How do firms manage financial risk? Okay. So strategies, again, these are the same 4 decisions that you are going to take. Okay. So it is just repeat, or again, they are giving you examples. But broadly, you have covered that in the first chapter. You know the examples properly. So that is repeated. So what is the example of accept? What is the example of avoid? Okay. So generally, we accept only those events or those factors, risk factors, where the impact is very, very small. Where the impact is very, very small. Then only I'll say that okay, I will accept and I will retain. If suppose there is a risk which is very high, okay, and I cannot manage it, it is way above the risk appetite level. Okay, now who finalizes the risk appetite level? It's basically the company's board of directors. Okay, they decide the risk appetite level. Okay, so if the risk is at a very high level, which you cannot avoid, which you cannot take care of, so you will have to take a decision to avoid that situation, which basically means you're moving away from that business, you are moving away from that project. Okay, so why this becomes very important? They have given you the example of 2007 and 8. A lot of these financial institutions, they created huge problem for themselves when they entered into risky assets like MBS, CDO, CLO. Okay, so these risky assets, if you cannot do anything of it, you cannot hedge and all, just sell and exit. That's nothing but avoid. Mitigate is very simple. You take steps to reduce the overall risk, reduce the overall spending and all of that. So broadly, the risk mitigating strategies. Transferred is one of the example of transferred is to take an insurance, okay, or it could be like enter into derivative products like cap, floor and all of that, so that you reduce the overall risk. Now using this, okay, the counterparty risk becomes very important, because if I'm transferring my risk to somebody else, say if I'm taking an insurance and that insurance company fails, then this is a wrong way risk for me, okay, which is nothing but a counterparty risk, part of the counterparty risk. This same concept will come in your level 2. So broadly, we have talked about this risk appetite and risk appetite relative to risk decision making. That means what is the status, what is the current risk appetite level, and how the decisions are actually made in the exam, also in the real life. So if you look at this, the first step, identify the risk appetite. Now it basically means we have to identify what are the different risks that we are facing. Okay, and then you have to take a decision how much risk we are willing to take, how much risk we have the ability. So they have given you a diagram. So this diagram summarizes the overall discussion, which basically says that I have the total capacity of managing risk, taking risk up to $200 million. But this capacity is not going to be my appetite. I will keep my appetite lower. Okay, or what is our tolerance level lower? Only at around 170 million. And the actual risk that I take in real life is lesser than the appetite itself. So why do we have this structure? So that you do not end up taking way higher risk than the actual capacity of the company. So that is what you should remember. Board of directors, okay, stress testing, problematic part, conflict of interest. How do we manage that? This is also one of the important section that they might ask you a theory and they might give you 2 statements. Like for example, 2 analysts are talking about it. They should give preference to shareholder. They should give preference to a bondholder, like that. So this is a conflict of interest, where when you're taking decisions in the company, whether this is going to be helpful to the debt holder, whether it's going to be more helpful to the security holder. Okay, this is more or less okay. Now, in this case, that when we read this entire section, okay, the several complexity that board may face, okay, the unity of risk seems to be very important, that we try to calculate the aggregated level of risk in some numbers, which comprises of market, credit, liquidity, everything, so that you try to get some idea. See, but the only challenge we face is that all the risk might be different risks might be calculated in different ways. So there you will face an issue. Entrepreneurial opportunities, okay, time horizon, possibility, and I'm only focusing on the important part. So this tolerance band can also you focus right now. So the effect is like this. Instead of giving a number, we say in the previous section we said the risk tolerance is at $170 million. Instead of giving a number, give a band so that people can fluctuate in that and they will get more leeway. They will get more flexibility in taking decision. Risk mapping as a concept is very, very important. So you basically look at individual asset, individual position, and you basically try to map what that, okay, at the portfolio level, whatever risk we are seeing, what is a factor within the portfolio that is impacting? Okay, what is the factor that within the portfolio that is impacting? So different types of risk, liquidity, operation, legal, regulatory, all of these risks are going to impact or get mapped properly into the business. Now this is an important task, because if the business cannot map it, they will not be able to identify the connections between the risk. Okay, so that is why the correlation becomes very, very important, because if the risk items, okay, if there is a heavy correlation, what will happen? Market risk will go up, the credit risk will also go up. That is problematic. So when they are mapping risk, they also try to understand what is the correlation between these different risk factors. More or less the same thing. Hedging risk exposure. Now, what we are going to do over here is, see, when we talk about hedging, they've given you both hedging in practice and hedging in theory. Okay, so in practice part is something which is slightly different, because what happens is they are trying to highlight that as a company, okay, if we do hedging, we have to keep some capital. Okay, there is a cost involved for it. Second is that we might not be an expert. So I am a Parle G company or I am a Parle company. I am expert in making biscuits. I'm not an expert in doing the hedging. So it is a cost for me. I might end up making a lot of mistakes. Okay. But if you are able to do hedging properly, what will happen? You will be able to manage the risk of the company properly, and hence the volatility will be managed, and hence the people will be able to give more better loans to you, or you will be able to enter into new market easily. Or your perception as a company increases. Okay. Potential for cash flow advantage also. When you do hedging, you are able to fix your cash flows. You know how much money is going to come because you have taken steps to take care of it. Okay, so that way hedging becomes very important in terms of the commodity price, in terms of the financial asset perspective also. A lot of companies, they do use hedging to smoothen their revenue. So they do not want to show higher amount of revenue right now. So they will enter into derivative position where they will have to pay something right now and they will receive money later. So basically what they are doing is they are smoothening the revenue. So that means the revenue cannot be very high, very low. It is average. Okay, because it gives a signal. It gives a signal to the investor. More or less this is okay. Cheaper. Theory disadvantage. Okay, this section you can definitely read. It's a zero sum game. We have talked about this. Okay, there is no what is the problem or criticism about this hedging, that even if you try to do hedging, what will happen? You might be able to protect yourself in one time, but you might lose money in the other time. So overall level, you're not making any difference. If you look at the economic level and the company level, you're not going to actually make any difference. That is the basic assumption, and that is why it leads to a lot of conflict. Now, when we talk about this, the argument assumes that the perfect market in this is an assumption in a lot of these theories. Perfect capital market information is freely available, information is available in timely manner. Then you also have representation from the lower strata of the society. You also talk about perfect capital, which talks about the transaction is happening at a very specific risk-free rate. Okay, you can borrow and lend at risk-free. So all of these concepts. More or less repeat disadvantage. This one, misplaced focus. Because you are not a company who is into this hedging business, if you divert your resources, you will lose a lot of business opportunity also. The cost of compliance is because you're hiring you're doing a compliance activity, you might have to do reporting to the regulator, you might have to do a lot of steps. That is going to increase your risk for the exam. Okay, so the next is leverage. If the leverage is very high in the derivative, the risk is also very high, because if tomorrow the derivative does not go in your favor, then automatically your risk is going to be higher in terms of the impact. Okay, so that way they have given you example of balloon payment and all, which is slightly you can read. Challenge involved with hedging strategy. Okay, so when you start to decide hedging strategy, the first thing that you have to ask is what are the different risks that I'm facing and which risk I want to hedge. Okay, so the major problem that they face is that they have not identified the risk properly, which can impact. Okay, and hence what happens is you realize that you when you do hedging, you misunderstand, you do not do the proper assessment of the risk, and you either do too high hedge or too low hedge. Okay, so that is why the overall impact is such that uh, the when you change strategies or when you enter into new position, you have to always look at whether the old position, okay, is all the risk identified and taken into account. If not, then I'll have to do reassessment of that. More or less is okay, simple. MGRM case has been highlighted over here. The same case is available in your modern portfolio theory. Sorry, learning from financial disaster. So this is nothing but entirely MGRM case. We'll be doing that also as we move to that section. This part again, conducting training. So how do we make sure that the organization, okay, is hedging properly? So you'll have to train the employees. Okay, you'll have to regularly communicate your goals. If there is any potential breach or potential warning, then that should also get highlighted. That is the overall thing. A top 10 risk is being tested in the previous exam, which focuses on how the companies are identifying top 10 risk, and some reference was there. Hedging operational and pricing risk. So pricing risk, we have talked about this. You want to enter into a market, you want to sell only at this price, but the counterparties are saying no, we cannot do the transaction. There is going to be definitely a pricing risk. Foreign currency risk is almost the same that we talked about. Firm's balance sheet is okay. Monetary asset, yes, net monetary asset. So once you've taken the asset, once you've taken the liability, you net it, and the final answer is the net monetary asset. So companies, okay, when they have net monetary asset, but they are in foreign currency, the challenge is this, that okay, if those currencies or if those bonds are going to get what do you say, settled, basically you have to pay now, mature basically, yes. So you face a lot of foreign currencies. So that is why hedging has to be done properly when you're in that situation. Okay. So they've talked about from that perspective. A lot of companies, they create their asset into different country in different currency. A lot of companies, they basically buy. Okay, they basically take loans from different country, different currency, so that they should be not be able to identify the overall nature in two sense. So over here they talked about foreign currency debt and foreign currency investment asset. Interest rate risk is very simple. You basically face a risk that, okay, for example, if you are Mr. A, your company is Mr. A, and you have already taken a loan of say floating rate, and you want to now enter into a swap. So how will you do that? So you'll enter into a swap, and whatever you have received, okay, you're going to pay whatever you have paid, you're going to receive. Okay, so floating is over here so that this and this get cancelled, and they have a proper fixed rate of payment, and because of which your final payments turned out to be fixed only. That kind of hedging is possible. If you cannot use swap, you might be interested in looking at prospective things, which is nothing but you might be interested in understanding that when the interest rate changes, okay, the fluctuation also happens, and that interest rate risk the net exposure that the organization faces. Net exposure is asset and liability part, right? So if you do not want to take exposure to swap, you can enter into derivative programs, like for example cap and floor, like that. Okay, so those they have given you. Dynamic, and this is more or less repeat, not heavily tested. Impact of tool. Now over here, okay, now even though the section is given, a lot of times they test you on this concentration limit and the maturity gap, which is the asset and liability mismatch. Okay, so how do we minimize the asset and liability mismatch? Okay, generally the liability is short term and the asset is long term. Either you increase the maturity of the liability, but if you start increasing, your cost will also increase. Okay, so your return or spread will become very small. The next thing that we can do is we can reduce the maturity of the asset. Okay, so when you're investing, you're not going to invest for longer period of time. Okay, now these things will basically reduce the overall revenue for the company. So it is not every time helpful. So you can get tested in the exam that what are the challenges, what are the unique part about this maturity gap limit, and how do we take care of that. That can get tested in the exam. Okay, so more or less we have reached toward the last bit of the chapter. Now this section is repeat what you have already seen in the book 3. What is forward, what is option, all that. So option and contract. So basis risk is again highlighted over here. What is basis risk? Mismatch. So if I look at the basis risk, it is like this, that okay, you have an original position, you have an asset A. Now when you go to financial market, okay, you have taken a futures contract, but the asset is B. There is a future on B, so this can lead to basis risk because the underlying asset A and B does not match. The second thing would be the maturity. Even though suppose we have A available and on which you have a futures contract, so this futures contract may be available for May, July and December, but the asset maturity is very different. It might be till June. So how do we manage that for 1 year, 1 month extra? If suppose I've entered into a May contract, how do I take care of that? So that is something, okay, is nothing but your maturity mismatch or mismatch basis risk content. More or less is okay. They have given you the example. So I hope everybody is good till this point. Can I get a quick confirmation? I'll address the query also. So top 10 risk का question बनता है. Yes, generally they can ask you which of the following could be top 10 risk. Okay, some serious issue with the organization. Will the video get uploaded? There is a network issue at my end. We'll try to upload the video on the YouTube. Do not worry. How put option helps in hedging? See, suppose if you have taken a foreign currency position, you have taken a short position. So if the currency rate goes down from INR USD 80, it goes to 70, it's a risk. So you take a put option on that and you basically protect yourself. Okay. So we will be now going towards the third chapter. I'll take a 1 minute pause. I'll be back. Okay, so we are back and we're going to be talking about the third chapter, which is your governance of risk management. Okay, now this chapter they mostly focuses on your the corporate governance issue. They focuses more, and this chapter can test you a lot of theory question from your book 1. Now, when we talk about this corporate governance, this chapter, there are a lot of theory, this acts and all that is not generally tested. Broadly, you should know what is corporate governance, what all different stakeholders which are available, okay, and that how those stakeholders can impact your decision making. That is broadly you should remember. Now over here they have given you the regulation, few part of the regulation. So this is something which is now becoming very, very important. So you should remember that, okay, when you're publishing your financial report also, it has to be signed by the CEO and the CFO, basically putting accountability with them. Okay. Internal controls has to be very strong. That means whatever is happening within the company, there should be checks and balances available. So if there is a risk committee, there is an audit committee, ethics committee, everything should get reported to them. Okay. There should be accurate disclosure to your investor and the regulator. So you can read that section also, that ideally it is now expected that the business will provide more information, more proactive information. The next section is regulation and governance after the crisis. So more or less this section, this part, declining in the lending standard. So when you read MBS chapter also, you will realize A lot of these banks, when they were giving loans, they were reducing their lending standard. That means they were asking very less question because their intention was to give more and more loan. Okay, so when you have these kind of situation where your lending standard goes down, your oversight breaks down, that means there's no manager to check what is happening. That can lead to huge impact into the business. Okay, so that is one way. Okay, further, management is more concerned with short-term profit, so they want to get bonuses. Okay, they want to get the bonus and they want to earn money right now, but they're not thinking about the long-term growth of the shareholder or the stakeholders. And these three things can get tested in your theory. Next is key lessons that they've learned from the previous failures. In that, the stakeholder priority and the board composition. Board composition has become very important because the regulators are also asking that, okay, you need to have one female in your board, or you need to have independent board members. The chairman of the board cannot be your CEO or something like that. So they are now becoming more and more stringent. Okay, so that whoever is going to sit in the board, he should be independent, he should be able to ask questions. So this critical eye concept, that should become more and more important. So that has been highlighted. Board oversight is okay. Risk appetite. So a lot of, if you highlight your risk appetite effectively in your organization, the chances of risk going down. So they might ask you the question with respect to whether your communication of risk appetite or clear articulation of risk appetite, is there any relationship between your risk actually there in the business? Srishti, answering to your query, which two position hold by a single person won't be a problem. So it is not like that. Primarily, we are concerned about somebody who is part of the decision making or the head of the board. So generally, a chairman. He should not be the person who is running the company, because then he will not be able to ask questions. Okay, because then it creates conflict of interest. Basel Accord. Now these things are not tested in the exam, so don't worry much. Okay, tier 1 net stable funding ratio is level 2 explicitly. Now why do we need all of this? Because we wanted to cover the liquidity risk. As a company, we should be clear that how the liquidity risk will be taken care of. So that's why, because in 2007 crisis, we realized that the companies, even though they have capital, the capitals are not worth able to convert it into cash. Okay, so that's the reason this liquidity risk and the net stable funding ratio actually came into picture. Okay, so almost this systematic important bank section you can read much more in detail. The globally systematic important banks. The responsibility of board composition we have talked about. Governance of conglomerate. This section, risk identification, monitoring and control. Okay, now they can ask you a question in basically the terms will be tested, whether risk identification, how risk identification is going to impact risk monitoring. Okay, like that. When mapping also, risk mapping as a concept also, whether the risk mapping should be known, should be done in detail, what are the steps they should take. Okay, what are the decisions that companies do take. So we have heard about it, no? The retain, avoid, and so this can get tested, and they might give you a thought process that, okay, the risk is changing every single time. So if the risk is changing every single time, your risk identification, monitoring and control should also be very strong. Compensation related questions can come. Deferred bonuses, then your clawback provision can be tested over here in this section. Answering to the query, so risk appetite statement is made by the senior management and approved by the board. So generally it's a risk team that creates a risk appetite statement. It is reviewed by the board, reviewed by the senior management, and finally approved by the board of directors. FRTB was also brought in because there were a lot of trading related issues that were happening. A lot of products were actually shown in the banking book, so a trading book which was not supposed to show in the trading book because it was a part of the banking book. So those things were issues. So that has been highlighted as an example that, okay, these acts were brought in. Dodd-Frank Act is okay. This section, strengthening the Fed. Okay, risk mapping, Dimple, is a generic concept. You can also read online that what is happening broadly over there. In the Schweizer book or in the GAR book, they have not got in much in detail because in level 2 they have seen. Okay, strengthening the Fed, it is more about giving more power, more autonomy, more capital so that if tomorrow because the regulator is not very strong, they will not be able to protect the companies. Resolution, living will is nothing but this concept of living will, you should remember, because what they're effectively trying to tell you is that when you're alive, you have to create a will that if tomorrow something bad happens, how will you get liquidated? Okay, how will you get liquidated? This one, stress testing. So they came out with CCAR. Okay, Dodd-Frank Act also had some references that okay, you have to do stress testing. They have certain set of stress testing that the banks are expected to follow, and certain additional stress testing programs that they have to do on their own, hypothetical scenario, historical scenarios, to see whether the company has good amount of capital available or in what situation the company will need capital. Okay, so that is one thing that that is being covered. So this is important. Stress testing part can get tested in your exam from the book one perspective also. So you don't need to remember $10 billion and all, because these programs have been initiated with the thought process that they are forcing you to do stress testing. Then the governance aspect, broadly this one, agency risk. Okay, so concept wise, it should be clear that there is a principal, there is an agent. If the interest of both principal and agent does not go in sync, what will ideally happen? Okay, then you will not be able to, your agent will not be able to perform. So the shareholders are the principal. Okay, then your board of directors, you have the senior management, they are agents. They are working on behalf of the shareholder. So the agents and the principal, their intention is not in sync, because the shareholders feel the company should have a long-term growth, but the shareholder senior management feels that no, I want to make good bonus right now. The board of directors are also focusing on the short-term growth. Then there is a discrepancy. So agency risk is very, very big, and it can get tested in your exam. Okay, look at this. The same point that I talked about. You focus more on short-term benefit, but you do not understand the long-term impact. So when you're taking decisions, you have to think long-term, and then your agency risk will get reduced. Okay, we talked about the clawback provision. If tomorrow the management, okay, if tomorrow the management does not talk about or does not take into account the what do you say, does not take steps which was expected as per the shareholders, then what shareholders can do, ideally they can include clawback provision into their contracts. So if tomorrow you make mistake, the company lose, we will take out all the bonuses that we have given you. Okay, then there is bonus bond also. All of these ideas are nothing but to minimize the conflict of interest between the agent and the principal. Basically, you're creating terms into your contract which connects back and says that we will take steps if you do not take action. Okay, if you do not follow the process. This case, MF Global case, is important. No? Mark this as star. If I'm not wrong, in the important concept video also I've highlighted this. Okay, now in this case, what happened again? Because the governance was not very strong. Okay, so John, who had a dual role, he was CEO and he was also the chairman. So when the CRO was highlighting that what positions you are taking is risky, nobody was there to counter question him, because both the decision making power was with the CEO of the company itself. Okay, so and because of which they ended up being they faced very big problem during the eurozone crisis. Okay, euro debt crisis, and because of which they faced a huge loss of around $1.6 billion, which ultimately led to their bankruptcy. So this example can get tested in the exam, and this has been asked in the past exam also. Risk management is okay broadly. Limit, authorized limit, risk limit. Okay, so your risk teams, basically what they do is they basically put limits to your traders, to your credit underwriters, or anybody who are taking decisions. Now why? Because if suppose you have taken an exposure which is higher, then the organization will face an impact. So what you do, you put limit that okay, you cannot approve a case above $5 lakh. Okay, if you want to do it, it will go, even if you approve, it will go to your senior manager and he will approve because he has more limits than you. Once he approves, then only the loan will be dispersed off. Okay, so risk limit as a concept can get tested. These are the basically from a practical perspective, what is board expected to do? Okay, they have expected to establish committees, because board cannot meet every single day, but these committees can be appointed and they can meet say every 3 months, every 2 months, and there they will analyze what is happening within the company. Then you need to have a compensation committee. We talked about this also. Maintain independent audit. So same thing, risk committee and audit committee should be independent. That means the people who are working, they should not have the influence on these committee. If there is an influence, they will not be able to identify the problems properly. Risk governance and implementation is more or less okay. Risk advisory. So they might ask you some question on risk advisory, okay, which explicitly focuses on that what is the role of risk advisory director. So they will give you a small scenario that okay, somebody has become a risk advisory director. Now he's basically talking to his friends, and somebody asks him what does risk advisory director does. So which are the 4 pointers given in the option A, B, C, D, okay, is connected to risk advisory director's role. That way they can ask you. Okay. Dimple, answering to your queries, CEO is somebody who runs the company. Board is the governance body. So chairman of the board can be a CEO, but it is not advisable. So these pointers broadly you should remember. Risk committee, what do they do? Okay, they are expected to ask questions. If there is a policy in the company, that policy will get updated, get renewed. So those policies has to be refined and approved by the risk committee, and then it will go to the board of directors. So relevant policies part, they are more on risk supervision also, because there are a lot of audits that are happening, a lot of risk related checks that are happening. Those things has to be verified by the committee. Okay. Compensation committee, the important part is this clawback provision, bonus bond. Okay, these things are important. If tomorrow if you have these concepts being added into your contract, tomorrow there is any problem, it can be taken care of. Now they can also ask you a question related to that, okay, if I have given a stock based compensation ESOP to my employees, then the conflict of interest comes down. They will not take they will think long term. Ideally it doesn't happen that way, because if I have given an ESOP, see, if the stock goes up even for a short period of time, you will be able to exercise the ESOP and he will be able to make money. So there is always a challenge over here. Okay, there's always a challenge that the stock based compensation can increase your risk of the organization. Risk appetite versus business strategy, this has been tested in the past exam. Okay, with respect to, both should be in sync. So whatever strategy you have made on a day-to-day basis, suppose my strategy is to become the top 3 private banks in India, then I will have to take a lot of risk, because in the sense that I'll have to approve a lot of risky loans. So my risk appetite has to be higher, or is that there's always going to be risk appetite breach, right? So they should be in sync. That is what you should be connected to. So there's a linking between risk tolerance and the strategy that the business is taking. Okay, at an overall level, the CRO or the CEO, whoever is the person who is responsible, he should make sure that whatever strategy and risk appetite that we have finalized, it should get in sync into the day-to-day operations of the business. Okay, you have to set risk limit, again coming back, and those risk limit has to be approved by the risk committee, approved by the board of directors. So more or less the same part. Over here, when we create risk appetite, okay, again one more important part. So how do you track risk appetite? Say for example, my risk appetite is that I will only take VAR up to $500. So how will I track? I will calculate VAR, I'll calculate stress, I'll do stress testing, that in what worst situation the VAR can increase. That is stress testing. Okay, so you will do stress testing, VAR, expected shortfall, to analyze what is the appetite level and what is my current level. So it is more from the tracking perspective, more from the calculation perspective. And you will do this for each asset, each region, each business, each product. We'll try to do that also. So that if tomorrow there is a breach, okay, then these limits which you have already set can help you. If there is a margin of error, okay, if there is a margin of error, which basically means that even if you have kept a limit, you have to give some buffer. So the question that they can test you is some theory connected to your margin of error and the limits. Okay, say for example, I'm a trader sitting in this and I see these situations happening. So which of the 4 point is more connected to the statement, more connected to the concept that I'm talking about? Okay, opportunity cost and all more or less repeat these things. Okay, mark this as star, which is nothing but if you want to reduce the compensation based conflict of interest, what you should be doing, you should not give you guaranteed bonus to anybody, or you should basically set limits. Okay, that means okay, your incentive based compensation, your bonus cannot be more than 70% of your CTC. Okay, similarly, if you can also add deferred payment, that means whatever bonus you are going to generate in this year, okay, you will not get the bonus right now, you will get the bonus 2 years later. So you're deferring the payment. So why we are deferring? Because we want time. We want to see whether how the performance is happening. If tomorrow, if the short-term benefit is only focused and the long-term impact is there, you will not pay the bonus to that person. So a lot of companies, they add deferred bonus concept also into this. And bonus bond is important, which is nothing but you will only get the bonus if you meet some regulatory requirement. If the liquidity of the bank is maintained up to a level, then only you will get the bonus. That way they connect. So that there is a responsibility also with respect to some formula, some ratio, some regulatory requirement. Independence was previously being tested in the exam. I have not heard about it in the last 2-3 exams. So not very important as such. Audit committee. Yes, audit committees related questions do come. Okay, that means what is the responsibility of audit committee? Who people can become a part of the audit committee? What do they check in the audit committee? Something like this. So responsibility related audit committee. So broadly, the first 3 lines you should remember. Whatever is going in terms of the financial numbers. Now, whether it is connected to some system, some person checking it, those numbers should be correct. So there should be control over the accuracy. That is basically being tested. So the audit committee related roles, questions can come. They have to look at the compliance standard. If the VAR calculation is getting, audit committee should verify whether the VAR numbers are matching or not. Likewise. So more or less this is okay. So I've completed 3 chapters. Now we're going to be moving toward the 4th one, credit risk transfer mechanism. I hope everybody is good till this point. And I hope this session helps you to do a revision of the important concepts, right? Let us move towards the next section, the credit risk transfer mechanism. See, the nature of the chapter is very simple. Okay, this chapter is actually connected to your mortgage-backed security and your anatomy of great financial crisis chapter, where the focus is on the how we do face a lot of credit risk in the business, but how do we take care of that credit risk in terms of tools that are available. So that way the question chapter focuses that. Okay, now different credit risk and credit derivatives. Okay, now over here broadly you should know what is CDS. Okay, so I'll give you an example, okay, to help you understand. Suppose I am Mr. A, okay, and I have taken a bond of Yes Bank. I took the bond and I paid some dollar amount and I received a bond. Now, after some time, after a few years, I realized and I faced that yes, this company is facing some risk. Yes Bank is facing some risk, and I'm afraid there is a credit risk involved because the bond money will not come back to me. So what I can do is I can go to a new entity, for example, AIG, which is American Insurance Group. Okay, and I can go to them and I can ask them, okay, please take a short position in CDS. I'm entering into a transaction and I will take a long position of the CDS, and in that CDS is on the Yes Bank, and for which I will be paying you a spread, which is a CDS spread. Okay, that CDS spread is nothing but the premium that we are trying to give to the CDS seller. Okay, and this CDS spread is, or the entire contract of CDS. If tomorrow Yes Bank collapses on those credit events, so I will have to mention that credit event. It can be bankruptcy, downgrade, restructuring, default also, delinquency also. I'll have to write down if any of those events actually happen on Yes Bank, then AIG will pay me. So it is a credit default swap. If tomorrow there is a credit default of Yes Bank, my counterparty will swap to AIG and he will pay me. Now there are a lot of things involved into this. Now think logically. Okay, this is the premium that we are paying. If there is a higher, now I'm asking you a question. If there is higher correlation between Yes Bank and AIG, the premium of the CDS, whether it should increase or decrease. Think, I'm repeating. If there is higher correlation between Yes Bank and AIG, in this example, the premium, which is the spread, CDS spread, whether it should increase or decrease. Come on, guys. Dimple, answering to your query, CDS seller is actually making the spread, no? He's getting the premium. So it is similar to an insurance company like Kotak or HDFC. They are selling insurance, they are getting the premium, right? See, if tomorrow there is higher correlation between your Yes Bank and AIG, okay, that means if I'm a buyer of that CDS, okay, if there is higher correlation, what will happen? Yes Bank will collapse and AIG will also collapse. So will I pay higher premium? No, because there is no guarantee that AIG will be there to pay me. So it is, the premium should go down. Premium should go down. Yes. Yes. Okay. If the correlation between them is low, then I'm willing to pay high high amount of spread, because I know if Yes Bank collapse, there is still going to be AIG who will be end up paying me. So the example that I asked you is nothing but wrong way risk. That is connected to wrong way risk. Okay, so concept of CDS should be clear to you, what is happening in CDS. Okay, now they've given you a lot of advantages and all. So cash flow potential, now whoever is a CDS seller, Dimple, answering to your query, whoever is a CDS seller, he will actually get the premium. So for him, if it's kind of like this, if nothing bad happens to CDS, nothing bad happens to Yes Bank, so AIG will only get the premium for an overall period of time. They will keep on getting the premium, correct? So it helps them to get a good cash flow as a business, okay? But how do they manage their risk? If tomorrow Yes Bank collapse, the entire AIG will collapse. So they will diversify. That is what insurance companies do. So they will diversify across geography, across industry. They will not, so insurance companies also, when they are giving insurance, they were not giving only insurance in Mumbai. They are giving insurance in Chennai, in Hyderabad, Jammu, all of these areas. So diversifies, right? So that cash flow potential and diversification is the core part of your CDS contract. That is what you should remember. Okay. What is the false sense of security? It is connected to the concept that if the correlation between Yes Bank and AIG is higher, then you have a very false sense of security, because if Yes Bank collapse, your AIG will also collapse. That is nothing but your wrong way risk that you are facing. Okay. More or less that is there. This can be both an advantage to access capital and disadvantage excessive risk taking behavior, which is nothing but because there is CDS available. And this was what happened during 2007-8 crisis. A lot of people, they took naked CDS position. That means even though I have not purchased Yes Bank, I am taking a CDS on Yes Bank, assuming that they will default. So a lot of people were speculating also. Okay, so that is the problem. Excessive risk taking behavior increases. Okay, the benefit of this is because CDS is available, I am being a normal investor. I do not wanted to take the risk of Yes Bank bond. Okay, I wanted to have the Yes Bank bond portfolio, Yes Bank bond in my portfolio, but I want to remove that credit risk. So I can enter into the CDS contract to remove that. So benefit is that it helps you to enter into a lot of it promotes that you invest into Yes Bank, even though there is a risk involved. You know that you can take CDS. So for Yes Bank, the capital is available. Access of capital is available because people will give them loan or will buy bond, because they know I can take the CDS and reduce my risk. Okay, CDO is more or less okay. CDO square can get tested. Okay, so what is CDO square? What you can simply do is, there are different ways to create it, but in a normal MBS product, what happens is you have a pool of a normal asset, and from this normal asset you create an MBS instrument. Now you can have different structures, like for example, you can have for example, senior mezzanine equity tranche. You can create that tranche, or it can be a pass-through security. There's no tranche, everybody has the same security. That can also be there. Okay, but when you talk about CDO square, okay, so what you can have a pool. One example of this could be, now instead of having a normal asset, a home for example, over here there are other CDOs into this. Generally you will find a mezzanine tranche of that CDO, which is very difficult to sell. And on this you have created a new instrument called as CDO square. Basically The pool is created of CDOs. Pool is created of CDO. Okay, that is the broader perspective over here. So you should be clear on the what is exactly CDO. Okay, what benefits you get. Okay, so this is highlighted. It has a lot of complexity, but if you have a very specific need in the market, then you can enter into these complicated products to match your need. Okay, tranches we have already talked about. Senior tranche in actually in your MBS chapter, these tranches are explained in much more detail, because there they are talking about senior tranche having low level of risk, so low return. The lowest tranche, which is the equity tranche, also called as toxic tranche, higher level of risk, high return, like that. Because there is CDO available, loan is easily available to the bank. So now think about this. What CDOs generally do, they basically repackage the loans or repackage the debt. Okay, CLO, CDO, all of these. So when banks are giving loan, they know because I can repackage and sell it. They are also not afraid on giving loans to companies. So a loan becomes very accessible because there is securitization market available. Okay. Increase profit potential. How come that be a concept? So if I'm a bank, I've given a lot of loans. Whichever loan I feel is slightly risky, I can create a part of that pool. Okay, and I can transfer it to somebody. So it helps me to get my money fast, and I can enter into new loans. Okay, and whichever is bad loans or slightly moving towards that, I can package and I can sell it. The major problem which a lot of people face is that if there is a concentration of risk, okay, concentration of risk, then you face a lot of problem. If the entire pool is made out of high risk borrowers, which was happening during the 2007 crisis, which was a subprime mortgage, okay, subprime mortgage, then what is going to happen? The entire pool becomes very bad and entire situation goes down for you. Okay, so this is your CDO. Okay, high complexity. Okay, I've only focused on important parts. CLO is more less risky because CLOs are made out of bank loans. When you say CDO, it is made out of debt, corporate debt. Okay, debt means bonds basically. But CLO is made out of, the pool is made out of bank loans. So when banks give generally loan, they do very stringent, due diligence, scrutiny. So the risk is generally very lower in this section. So that is one point that you should remember about the CLO. Rigorous underwriting process, right? Mezzanine tranche, Dimple, can have a mix, low risk and high risk. So basically they behave sometimes in some situation they behave similar to a equity tranche, sometimes they behave similar to a senior tranche. How do you reduce your credit risk exposure? Okay, so one is very simple, you take insurance. These things are somewhat easy concepts. The main thing is wrong way risk. We talked about this. So you can ask your counterparty to put collateral. If you do not want to face the risk, you ask the counterparty to put the collateral. Now think about this. Banks, okay, banks basically they have when they give home loan, they have collateral available. So even if the borrower defaults, the collateral is available and they can sell the collateral. But there can be wrong ways, because if suppose on the same time the customer defaults and the value of the collateral also goes down, then that is a wrong way risk, because then the collateral is not able to support you. Okay, so collateral is not able to reduce your risk. So example that they've also given in the book, that you have given loan to somebody, loan to an oil and gas company, and the collateral that they have given is oil barrels. Tomorrow if the oil price goes down, the company will also default and the value of the collateral will also be very low. So that wrong way risk you should be clear. Syndication, this gets tested, okay, in the exam. So you have either a firm commitment syndication or best effort. Syndication is nothing but few bankers would know very well. They come together and they give a combined loan to somebody. Okay, so I think so. The Vijay Mallya loan was also syndicated by SBI. So whoever is the main bank, they get some portion. Okay, and the main bank can do it either in terms of firm commitment or either in terms of best effort. For best effort means I will try my best to convince other banks to give you a loan. If it is okay, if it works out, it's okay. If it doesn't work out, we cannot do anything. So over here, you basically charge a fee. That okay, I'll try to help you. But when you give a firm commitment, what we do is, suppose SBI is saying that you need 5,000 crore, we'll get all the banks together. Suppose they are able to pay 3,000 crore, rest 2,000 I will give it to you. Okay, yes, in banking terms, we also call it consortium loans. That's correct. Okay. So this can get tested. Credit derivative, this is more or less a repeat, not very important. repackaging was also there. So adjustable rate mortgages were issued. That means with teaser rates they were sold. So the customers were initially given the floating rated loan, but the premium or the rate of interest was very low. So they was given only 1% interest EMI rate, but the teaser rate was only for 2 years. After 2 years, the rate will go to 5 to 6%. So they were facing a lot of problems. Okay, they started defaulting. This section you can remember, section 15G, mark this as star also. So it is nothing but what we are doing is this section has come out that if you are selling CDO, if you are selling structured product, 5% should be in your book. You cannot just remove everything out of your book. So that means you have to take the lowest 5% risk, the lowest equity tranche risk in your books, and then only you can sell these products into the market. Okay. Answering to the query, Shikhar, mezzanine tranche rating and senior tranche of CDO square made from the same mezzanine tranche, what has the highest rating? See, ideally, the tranche of CDO square made from the same mezzanine tranche. So, which has a higher rating? Might be because if I am able to understand it correctly, the senior tranche of the CDO square should ideally have a higher rating, ideally. Special purpose vehicle securitization. Over here, they've explained you the overall process of securitization. Okay, that means you have a pool, you basically take the pool of variety of asset and then you basically create one more special purpose vehicle. Now I'm assuming that people who are going for the exam, they will be clear on the concept of that. Okay, and this SPV will basically sell the tranches or sell the security through these tranches. Okay, senior mezzanine equity is one example. That's a waterfall structure that they follow. So this is more or less repeat. See, originate to distribute and buy and hold, this by basic bifurcation should be clear. So right now, if you go and take, say, a loan from HDFC Bank, so they will originate the loan. They will only give you the loan if they are willing to hold that loan. Okay. But if suppose we get into originate to distribute, what will ideally happen? The bank is originating the loan thinking that I will repackage it and I will sell it. That means we will do securitization. So the thought process is different in these two products. Okay, originate to distribute and the buy and hold part. With this model, bank do not retain the creditors because in the buy and hold strategy, they are going to retain the creditors. But in the originate to distribute model, they will just originate the loan because they are not going to hold the creditors. They will repackage it and they will sell it to somebody else. Okay. The incentive in the OTD model is to generate high volume because the more higher volume, the more processing fee, more charges you can ask. Okay. So the quality is not very important focus, the quantity is important focus. This can get tested in the basic difference between the OTD model and the originate to distribute model. Okay. What are the advantages? You are able to better manage your risk because if there is a loan on your book which you want to remove, you can enter into securitization and put that loan into your into your portfolio, and then you can sell. Disadvantage, this moral hazard is very, very important. You're creating a pool of those assets which are very, very risky. So people who are going to buy that loan or the pool is going to face the problem. So that is the moral hazard concept that is basically being tested. Misaligned incentive, people focus only on short-term money. They don't look at the long-term success. So when you create the portfolio also, you are thinking that I just need to add a asset into that portfolio which can just sell out in the market. In future, if it defaults, that is none of my concern. That is misaligned incentive. Okay, so a lot of originators, a lot of the arrangers who are creating these pools, they never thought that whoever is going to buy the asset, the investment advisor, also the pension funds, mutual fund, they will face problem. That was not considered. And they were also very complicated. So that was the opaqueness. So off balance sheet entities are your SIVs, SPVs who are being used to sell these assets into the market. Okay. So we've completed the first 4 chapter, modern portfolio theory. Okay. So modern portfolio theory is nothing but you're mostly talking about how the portfolio is created, what are the major factors, what is CAPM, okay, those things. So if you want to remember modern portfolio theory, the base of the modern portfolio theory is that we are looking at 2 things. We are looking at the risk, which is nothing but the variance, and we are looking at the expected return. This is called as mean variance framework. And what we do, we basically try to find various combination of portfolios that I can create for various combination in terms of weightages, and what is going to be the risk and what is going to be the return. Okay, so that is what is basically expected. Okay, so you basically create this. This is nothing but a portfolio possibility curve. Okay, portfolio possibility curve, and this point refer to your minimum variance portfolio. That means if you create a combination of this portfolio, this is going to be lower risk, but this is not your optimal portfolio, because every time an investor might not want to have a portfolio which is low risk. Okay, so from here till this is your efficient frontier. This is your efficient frontier. That means if you are into that, if your portfolio is into this range, then you're much better. Suppose there is asset A, okay, and asset portfolio B, A and B. Which portfolio will you choose? Ideally, portfolio A, because for a given amount of risk, you're getting higher amount of return. Similarly, suppose this was portfolio C, and right exactly in front of that, it was portfolio B. Which portfolio will you prefer? You will always prefer portfolio C, because for a given amount of return, the risk was lower. Okay, that is the core concept of this chapter. So if I just open up and look at the broader things, assumptions are very, very important for this chapter. Okay, returns are normally distributed. Now this assumption is not true in real life, because all financial assets do not follow a normal distribution. So this can be a problem. But when we assume normality, we say that the standard deviation and the risk return, these are the only two factors which we are going to be looking at. We are not going to look at skewness, cutoffs, anything. Investors are rational, they only take decision on the basis of risk and return. That might not be true. So the utility function is driven, okay, by these two factors only. That is what the theory assumes, but that is not true. Risk averse investor, normally the investors are risk averse. That means if they want to take risk, he should be compensated with high amount of return. If I am high risk averse, high return should be given to give me to take the risk. Okay, capital markets are perfect. Information is easily available. There is no entry exit barrier, or the cost. There is no friction. So if I want to enter into the transaction, there is no security transaction cost. There is no taxes. There is no brokerage fee. Anything that is assumed, but that might not be true. Okay, so capital markets are assumed to be perfect. So all of these three assumptions are important. The portfolio possibility curve that I was talking about. Now in this diagram, they have highlighted if I change the correlation. So if I keep the correlation as 1, so this is going to be the diagram. This straight line is going to be diagram, which is a worse situation, because your risk is not getting reduced. But if you look at this situation, which is the correlation being -1, so the portfolio possibility curve becomes 2 line. Now when you look at this 2 line, there is one situation over here when your overall risk of the portfolio can go 0. So that if you want to find the minimum variance portfolio for when the correlation is -1, they can ask you like this. Okay, you know what is going to be the risk of that minimum variance portfolio. It's a theory question. It is going to be 0, because when the correlation is -1, the entire portfolio possibility curve will become 2 line. It will touch the y-axis. That is what you should know. Okay, how do we reduce the overall risk of the portfolio? When you diversify, you remove the company specific risk. You are only facing the market risk. Now this concept is very simple, but the overall thought process of the portfolio possibility curve or the Harry Markovich, the concept was same. The more assets you add, the more diversification you bring in. Okay, and because of which all the company specific risk you will leave out. Okay. Answering to your query, Dimple, in CAPM, there are question tests like which is better diversification, why is this higher better? So see, questions are more or less theoretical in this chapter also. CAPM, only 1 or 2 section, like for example, Sortino ratio, or sorry, not Sortino, Sharpe ratio, Trainer ratio, that can get tested in calculation. But most of the rest of the concept is theory driven. Efficient frontier, we talked about this. This is your minimum variance portfolio. Anything between this is the efficient frontier. Okay, so if you're comparing A and E, which asset you will hold? You always hold E, because for a given amount of risk, the higher return. Okay, similarly, if there is an asset X, so X and C, you will always prefer C, like that. So one more thing that you have to look at from the efficient frontier is if you're going to be closer to G, that means you're trying to be taking more risk, okay, in your portfolio. So depending upon where you want to, what kind of investor you are, okay, either you'll try to hold asset closer to D if you do not want to take much risk, or you are afraid of taking risk. If you want to take more risk, you'll be closer to G. That is what is also explained over here. Capital market line, okay, so now in your if suppose you hold a portfolio which is M, which is also an efficient frontier, plus you also have a risk-free asset, then your entire line curve is not now important. It is basically this line, the capital market line. Okay, this basically tells you that minimum to minimum you will be making this risk-free rate. And if you are in between this, that means if in this range from RF to this M point, this is what can get tested in your exam. That means you are investing some portion of your money into the risk-free security, which basically means that you are lending to somebody, because you are lending to government. But if you are into this range, suppose there is a point over here, there what is going to be the case? The risk-free security has been shorted by 30%, but the portfolio M has been invested 130%. At a broader level, your weightage is still 100%. But what you are doing, you are shorting risk-free security to get the money and invest into risk market portfolio, because market portfolio gives you more return. Okay, so your risk is also increasing, your return is also increasing. Okay, but when you are into this range, you are actually borrowing at risk-free rate. If you are in the other side, you are lending at risk-free rate. That concept should be clear to all of this. And this capital market line is tangent line to that efficient frontier. Okay, this formula. So if I would be testing you in the exam, suppose, then I would give you this I will ask you questions related to capital market line formula, but I will explicitly ask you what is this. Okay, this is nothing but your Sharpe ratio. Okay, return of the asset minus the risk free rate divided by the riskiness, the sigma. Okay, so that can get tested. Or I might give you a formula saying that RF plus Sharpe ratio plus something, is it connected to your capital market line, something like that. Okay, so do not ignore this formula. This does get tested in your exam. The capital market line, all of these formulas are important. Okay, what is this? Information is freely available. There is no friction in the market. You can divide the asset into multiple divisible part, and then you can take position. Okay, borrowing and lending is going to happen at a risk-free rate. All of these things. Okay, the decisions are primarily based on return and risk. There is no other factor which is going to impact. So that one, everybody in the market has the same expectation. Homogeneous, they do not have heterogeneous expectation, homogeneous expectation, right? So all of these assumptions are very, very important. Do not skip that. Beta, what does beta tell you basically? That if they ask you theoretically, they can test you that it tells you sensitivity with your asset or with your market basically. How do we test that? So you basically do a regression in which, so there is an independent variable X, dependent variable Y. Okay, over here what you are going to do is you are going to look at RM minus RM. That means how much extra you're earning, the market is earning from the RF. Okay, and over here you're going to take a return on the portfolio minus RF. So X is return on the market, X is return on the portfolio. When you take the data and you basically do the regression, you'll get a line of best fit. The line of best fit, the equation is going to be B0 plus B1X. This B1 is nothing but your beta, which basically tells you what is your sensitivity. Okay, what is your sensitivity? That is what the beta explicitly talks about. The formula beta, this formula is important. Again, do not worry, this is similar to the formula of slope coefficient in your regression chapter also. Covariance between independent variable and dependent variable divided by the variance of the market. This formula is important. Okay. Now these kind of question very difficult to get tested in the exam, because this is a very straightforward question, but it can be combined with some theory and asked in the exam. The formula of covariance divided by the variance. Okay. See, this is the same concept we talked about, the regression line and the slope, same concept. Deriving CAPM. So derivation is not important. So even if you're reading, don't read that. Ultimately, this diagram is important because it tells you what position you should take, and that I'm going to cover now. Okay, but broadly you should remember what is the formula of CAPM. This one, RF plus risk, market risk premium. What is market risk premium? RM minus RF. So that market risk premium into the beta. Okay, now this will give you what is the expected return from that asset. Now what is the concept? Why am I only saying market return? Because I am assuming that even if you have a particular asset in hand, okay, your risk of holding that asset is only the systematic risk, because you can take that asset and put it in the portfolio and you can diversify. So I will not give you return for that unsystematic risk or the idiosyncratic risk. I will only give you return for the systematic risk. That is why I'm only considering RM. Okay, and this CAPM formula can be looked at for a portfolio, can be looked at for a single asset. But when you look at capital market line, that formula, it is only for a diversified portfolio. Okay. Now this entire concept of minimum return, that hurdle rate. So the return that you're getting from the CAPM, it is nothing but telling you that if you're holding a particular asset, what is the return that ideally you should be getting. So this becomes your hurdle rate. But okay, this is the minimum return I should be getting. That is what they are highlighting. Okay, so if your project or if your asset is able to, if you are expecting that the asset will give you higher return, then only you should buy that asset. Okay, that is the concept. Now I'll just quickly come back to this diagram. Okay, so you can think of this diagram as for a particular beta. Okay, this is my SML line. Okay, and let us assume that this return is say around 10%. This is the expected return. Okay, this is the 10% point. Now suppose there is an asset which is giving you slightly higher return. Suppose it is giving you around 13% return, which is over here now. So what will you do? Will you buy that asset? Will you sell that asset? I am asking a question to you, all of you guys. Will you buy the asset or will you sell the asset? I hope people will answer. So if an asset is giving you 13% return, the CAPM return is 10%. Will you buy the asset? Will you sell the asset? You would actually buy the asset. Why? Because the asset is undervalued. If suppose the asset is only giving you 8% return, then you will say, oh, the asset return is very low. So I will sell the asset. Why? Because currently it is overvalued. So when you start selling, the price of the asset will go down. Okay, when the price goes down, the yield will go up and you will come and touch over here. I'll change the color. So you will basically come and touch over here. Okay, similarly, if you're undervalued and you're buying the asset, so a lot of people will start buying. What will happen? When you start buying, the overall asset price, okay, will go down. Okay, so sorry, asset price will go up and the yield will go down, and this 13% will come and match the section. So equilibrium will always maintain. That is what the CAPM tells you. That equilibrium will always be maintained. Okay, so coming back to this section, this is the same beta formula, very similar to that. This kind of question might not come directly, but this analysis is important. See, you calculated, you got an 11.1%, 5% return. This is the CAPM return. Okay, if the return is exceeded, that means if the asset is expected to give you more return, what will you do? You will buy the asset because it is undervalued. If the asset is expected to give you lower return, you will sell the asset because it is overvalued. The same concept. And the same concept is also highlighted over here. Okay, that is what you should remember for the exam. Now, how do you analyze the performance of the portfolio? That has been covered over here. So there are different tools, like for example, Sharpe ratio, Treynor ratio. The basic difference between the Sharpe and Treynor, you should remember that the Sharpe takes into account the overall risk. The denominator is sigma, okay, the standard deviation. But when you look at Treynor ratio, it only takes into beta. That is the only market risk component. That is the part that you should remember. Okay, that is the part that you should remember. Higher measure, more or less the same thing. This formula can get tested in the exam. So a lot of times what they do is they will ask you a question in comparison. Okay, in terms of your Sharpe ratio, trainer ratio, which ratio should I take. If my portfolio is diversified, then trainer ratio is good. If it is not diversified, Sharpe ratio is good. Okay, in terms of measuring, if I'm comparing portfolios that way. Trainer ratio, again, I talked about this. Beta is the major section over here. This is CAPM return. Okay, it's CAPM formula. Now they are basically connecting both your if you calculate the trainer ratio for the market portfolio, okay, the beta is always going to be 1. So in this case, the numerator is going to be equal to your trainer ratio. That what is the numerator? Numerator is market risk premium, because it is RM minus RM. That is something which you should remember, the broader concept. Jensen's alpha, how your asset is generating higher return as compared to the CAPM return. Again, Jensen's return, Jensen's alpha and trainer ratio. If you compare the portfolio and calculate trainer ratio and Jensen ratio, the ranking is going to be same, because both of them focus on the beta. Both of them focus on the beta. Okay. If your portfolio return is higher than the CAPM return, that means you are generating alpha. You are actually doing better. That means a positive alpha. If you are performing bad, that means you are in a negative alpha situation. Okay. They both focus on beta, which is nothing but the systematic risk. This question is almost the same. Now, over here, the analytical part of question can come. They might ask you to calculate both trainer and this, and what they will do is they will basically analyze. They will ask you a question: why your portfolio is market is performing better in Sharpe ratio, okay, as compared to your portfolio. They might theoretically ask you that. So market is able to perform better because the standard deviation of the portfolio market is lower, because it is more diversified. When your standard deviation is lower, your Sharpe ratio will shoot up. That kind of analysis can be tested in your exam. Tracking ratio, tracking error is also called as active risk, which is nothing but the alpha that you are looking at, how it is, what is the standard deviation of the alpha, because every single time you will not be able to get a constant alpha. It will move. So that tracking error talks about the standard deviation of the alpha. Okay, and this becomes a part of your tracking, your information ratio. Okay, part of your information ratio. So denominator active risk, I talked about this. Numerator is your alpha. That is nothing but your active return. So per unit of active risk, how much active return you have been able to generate. That is what the focus is. Okay. Sortino ratio, the denominator is downside deviation. So basically you need to remember that when you do standard deviation, okay, think about this. This is my average. When I talk about standard deviation, I look at both up and down. Okay. But what Sortino ratio is saying, I am only concerned with going down. If there is a variation on the upside, I am not considered keen on that. So when you do the calculation of standard deviation, okay, I am only looking at when you are going below the minimum rate, because you are considering the numerator, which is the minimum, R minimum. You are not actually looking at average, looking at R minimum. If you are going below the R minimum, then ideally you should be we should calculate that deviation. We should not look at the deviation above the R minimum. That is a broader concept, okay, of Sortino ratio. So over here they have given the calculation. The Pharma French, no, it is done. It is done. So it is Pharma French is going to come in the next chapter. Okay, so we'll take a pause for today. I hope everybody enjoyed this session, and a quick brush up happened about the concept which is there. And wherever possible, I'm trying to give you the perspective of what kind of question can come. Okay. Tomorrow when we start, it's going to be starting from arbitrage pricing, or the next chapter is arbitrage pricing theory, right? So tomorrow we are going to be starting from that, the arbitrage pricing theory chapter, and then we'll be considering. Okay. Yes, Paras, what is the question? And I hope everybody is enjoying the session. It is beneficial for you guys. So I'm trying to help as much as possible to people who are preparing on their own. Okay. And either you're my student or you're a student outside, okay, then you still, I will try to help you out. 5.3 ka first question. What is that? For a given portfolio having a trainer ratio greater than the market, but a Sharpe ratio less than the market. We talked about this, no? If you go back to this example, what is happening? If this is portfolio, this is market. So my trainer ratio is better than the market, but my Sharpe ratio is lower than the market. Why is this happening? Because my portfolio is more diversified. Okay, my benchmark, sorry, my market portfolio is more diversified. When it is more diversified, the overall risk is lower, and because of which my Sharpe ratio is higher for the market portfolio. Right, Paras? I have answered the query. Is alpha same as active return? Yes, that is active return only. See why you are getting active return? So you are deviating from the benchmark. When you are deviating from the benchmark, you are actually deviating to get some extra return. That means you are actively taking step. That is why we are talking about active return. Okay. So thank you very much, guys. We are going to be closing for today. Tomorrow at 5, we are going to be starting with the next part of the chapter, and we'll complete the overall book one tomorrow. Okay. So thank you very much, guys.